All right, there we go. There we go. Welcome, everyone. How you doing? We're going to start. So I'm Andrew Rosen, president of Diversified. Thank you for coming out tonight. I know what you're wondering. Phillies are up 6-1. So let's keep it going. I'm glad my tickets are for tomorrow because it would have been weird to do this from Philadelphia at the stadium. But thank you for coming out. Okay. Anyways, thank you for coming. This is the 11th year we've done this, believe it or not. I see Frank Levy here. I remember the first year he was up here doing it. Did not as good a job as I'm going to do tonight, but that's okay. We still killed it. In all seriousness, it's been quite a ride. I want to first thank everyone here for coming. Without your support and care and trust through the years, we couldn't put on things like this. You are a reason for being. So thank you very much. Thank you for Kelly and Sarah for coordinating tonight, DuPont Country Club, the lovely Nick Star team, our special guests, which I'll introduce in a few, and all our corporate sponsors. So thank you. I just want to say a couple quick words, and then I'll run through our format tonight, which if you were here last year, will be quite similar. So this past year has been quite a ride for us. We've had a lot of growth. We're growing the right way. We've invested a ton in our company, in both our talent and our employees and our resources, because we are dedicated to giving the best value-based process in the country. That is our goal. We're going to keep expanding and adding talent through the years so we can keep delivering on our promise of progress, not perfection. And we appreciate you staying along the ride with us, because I know it's been a journey and it will continually be a journey. But without you here supporting us again, none of this is possible. So thank you for that. Thank you for sharing what we do with others, because it really means a lot. And it's the best form of advertisement. So thank you for that as well. And so that's all I wanted to say. I wanted to just generally thank everyone here or that's streaming. We appreciate you. We're committed to you and our process and this company flourishing. And I'm not going to waver on my promise, which is to continually invest in you and your future so that we can have you living wealthy, healthy, and happy lives through the years and enabling you to get the best out of life, because that's what it's all about, if you ask me. So tonight, I'm going to lead a fireside chat with David Lebovitz and our own CIO, Mike Horwath. I'll proctor it. We'll open up questions at the end. As always, world's in turmoil, seemingly always. Let's keep the questions pertinent, not specific necessarily to your situation, so we can just keep it more generic. We appreciate that. Let me give some quick intros, and then we'll have some fun, shall we? So, David works at JP Morgan. He's the global market strategist. He is, he's on the JP Morgan Asset Management Global Market Insight Strategy team, where he's responsible for delivering timely market and economic insights to clients across the country. He's appeared on CNBC, Bloomberg, and has been with JP Morgan for 12 years. Round of applause for David. Thank you for coming down. And he does not have his kids, what was it, Parent Day. So he's happy to stick around. Mike, which you've seen, if you've seen any videos or emails, he is the man behind the cloth. He's our Oz. He is, what else can I say? He runs all our portfolios. He's awesome. We're thrilled to have him here, and he's running all of our money. His team is great, and let's give him also a round of applause. Thank you, Mike. With that said, I'm going to take a seat and kick this thing off officially. So, Mike and David, if I win the $1.7 billion lotto tonight, oh, sorry, that's not on here. Anyways, Mike, can you start us off with major themes this year in both market and global economy, and what have been the major market movers?
Perfect. Can everybody hear me? We good? Back corner? Yes, no?
Oh, yep. Okay.
Good? Okay, wonderful. So 2023 has been quite a year. My 2-year-old daughter has made it a longer year. Anybody who has knows we've hit that age, but work life has been chaotic as always. I think Andrew kind of pointed out, right? Markets always have something going on. Always. Good, bad, and different. 2023 has been no different. So I think the best way to maybe think about themes is maybe the good and the bad, right? The positive, the negative, what's happened throughout the year. Let's start on the bad side, right? Coming into the year, rates are high. I'm not telling anybody anything you don't already know. Interest rates are higher than they have been in quite some time. Like historically speaking, I wouldn't say they are historically high by any stretch, but relative to the last 15 years, rates are higher in an effort to slow inflation, right? The Fed has been very aggressive to slow the economy. That's the entire point. But rates are higher. Higher rates obviously create a more challenging environment for lending and for borrowers specifically. So that's been a natural challenge at first. Second, if you go back to the February-March timeframe, if you think about those higher rates having an impact, we had a little bit of a banking crisis. I think it took a lot of people back to 2008. And what happened there? Very different scenario, right? I think we should start there and clarify that. But we saw two banks, multiple banks, really, it's go out of business, right? They weren't the biggest banks. They weren't the JP Morgans of the world, but these are large regional banks that have a massive presence. Ripples were felt. So there are multiple factors, but one of which was higher rates forced them to be holding on to securities which were at substantial losses. And as there were runs on their deposits and news came out, they had no way to liquidate those funds because of the massive amount of losses. So in the end, right, from a bad perspective, you saw how fragile the banking sector could be at times. The government stepped in, which was great, but we saw some fragile points from the banking sector. Even going farther during the year, our government situation is classically very fragile as well. We saw from a May timeframe on a lot of questions about the debt ceiling, right? As you guys remember, there was constant talk from Secretary Yellen about the U.S. government not having the funds and the legal ability to pay their debt. That's kind of a problem, right? So Congress, as they always seem to do, especially more in recent years, has pushed that to the limit, used it as a negotiation tactic. We anticipated it would fully get done. It did get done, but we should all anticipate that this kind of dynamic is going to continue to happen. It creates headline risk. It creates volatility in markets, but you can see how fragile our government structure can be at times. And then I think another negative has clearly been China's a mess, right? China just in general is a mess from a consumer perspective. Their demand's not there. Their growth's not there. And their property sector is a complete train wreck, right? So that combination has really made it, quite a year. And from a Chinese perspective, I think part of it is, one, their demand is needed. Countries like Germany are export heavy. They require, buyers of their goods. And China is a big part of that. But China is also the second largest economy, and we can't ignore the challenges that they felt. Despite all of that, there have clearly been really positive things, right? Inflation's coming down. So rates are higher. We started with that. Inflation's coming down. We are in a disinflationary environment. The good part is what the levels we saw last year, the middle of last year, the 6, 7, 8, 9% on headline, which includes energy and food, we're nowhere near those levels. We're seeing the 3s, the 4s. We're getting back down to that 2.5% target by the Fed. That's their objective. They're getting there. It's going to take some more time. Part of it is energy coming down. What's been sticky has been the housing market, right? Shelter costs, both owner's equivalent rent. So rent prices, housing prices have been slow to respond. But by and large, inflation's coming down, which gives the market comfort that the Fed at least shouldn't be as aggressive. They came out today and said that maybe there's one more hike that they're thinking, small one, but they're largely done. what people shouldn't be anticipating is that rates are going to start getting cut extremely quickly. But by and large, inflation's coming down. We also see corporate profits, corporate margins really healthy, and really just corporations in general really healthy, right? You don't see leverage extremely high. You don't see interest coverage in a really bad spot, meaning, a lot of these companies refied their debt when interest rates fell. They pushed out their maturities. So from a debt perspective, they've taken on some or they've refied, but their interest coverage is really low. Their interest payments are now much lower than what they were. So there's just less concern from a corporate perspective of leverage and interest coverage. And you see that in the bond market that's pricing in a pretty muted default area right now, right? So default rates have been low. We anticipate that they're going to remain low. So that's been a really good spot, both corporate kind of health along with, earnings and margins. We've all seen, obviously with inflation, their top line revenue growth has been there and they've been largely able to pass along those costs and maintain their margins. We'll see if they're able to continue to do so. But, as we take a look through what's going on from an economic perspective, corporations are in a good spot. And then sticking with the economic, space, U.S. economic growth has been really good, right? At least it's been surprisingly resilient. I guess that's the better way to put it. So we haven't seen a recession this year. We probably don't expect a recession at this point this year. Things look pretty strong. And if that is the case, and we'll talk about it likely today, is that's been pushed off. So from an economic standpoint, a corporate standpoint, inflation coming down, there's a lot of optimistic things in the market kind of outweigh what we saw earlier this year from a negative side.
Can I add just two small things? So one, on the good front, we saw a lot around artificial intelligence and AI. And one of the big challenges that the US economy has faced over really the better part of the past couple of decades is that you can essentially break down economic growth into two variables: growth in your labor force and growth in productivity. Both have been slowing for the better part of the past 30 years. And I think while it's still perhaps a couple of years off, right, the progress we're making with AI and large language models does suggest that there could be room for productivity to be more additive to economic growth going forward. And so what that could help do, again, over time, is turn what is a 2% growth economy in the US today into maybe more of a 3% growth economy like we had in the late 1990s and the early 2000s. So just one good thing I wanted to add. And, when I think about the good and the bad, I also think about the ugly. And on the ugly front, I think what's been happening in terms of the rise in long-term interest rates is a little bit unsettling. I think that part of it has to do with the Fed, and I'm sure we're going to talk about the outlook for policy rates. I think part of it has to do with the better expected growth outcome that we've seen this year. But I also think that some of it has to do with dysfunction in Washington and deficits that continue to increase against the backdrop of economic growth, right? Usually governments run big deficits when the economy rolls over. What we're seeing here is that government spending is accelerating when, frankly, the economy looks pretty good, like you said. And so, what's been so interesting to me is that there are all of these cross currents that we've observed. And then you look around and the equity market's up more than 10%. And I think that that's caught a lot of people by surprise. So back over to you.
Oh, excellent. So Mike touched on the scary R word, recession. And we sat here last year, and I believe one of you quoted that it's the most anticipated recession we've ever expected. However, we've not hit a recession. So David, we're going to hit a recession in the next 12 months. If so, does it matter at the end of the day, or if it's a technical recession or not? What does your team see?
So the first thing I'll say about recessions is they're always a question of when. They're never a question of if. And you're exactly right. We came into this year with everybody looking for a recession, myself included. We all thought that at this point in 2023, the economy would have cracked under the pressure of higher rates. In the event, that has failed to materialize. And a big part of the reason why is that the labor market has stayed tight, right? The unemployment rate is still below 4%. And consumers have cash in their pockets that they've been able to use to push back against inflation. And so we think we understand why the recession that everybody was looking for didn't materialize. But I personally struggle to see how the Fed can take rates from 0 to north of 5 in 18 months without something breaking. And I would argue that what happened with the banks back in March was the first thing that broke. Then the Fed rode to the rescue, injected a bunch of liquidity, rates fell, that kind of put that whole hot button issue to bed. I do think that it has simply delayed the recession rather than deferred it. But we were talking about this earlier on as we were preparing for tonight's conversation. And if you think about the distribution of outcomes around recessions, if you talk to most economists, and we would generally agree with this, there is a very low probability that we are going to continue to grow at the pace that we've been growing at this year. There is also a very low probability that we're going to see a massive blow up like we saw in 2008. And so what we're focused on here is a range of outcomes that is actually relatively narrow. We could see GDP roll over and contract by a couple of percentage points, or it merely slows to 1%, potentially even lower over the course of 2024. But I think the important thing for everybody to recognize here is that this is what the Fed has been trying to do. I always think about inflation as being it's like economic sweat, right? So if you walk down the street, unless it's 100 degrees outside, chances are you're not going to perspire. If you run on the treadmill for 20 minutes, most of us are going to begin to shed a few droplets. The economy is the same way, right? Trend growth in the United States is about 2%. So when we're growing at 2%, you wouldn't expect a whole lot of inflation to be generated. But when you're growing at 3 or 3.5%, like we are in the third quarter, right, that makes inflation more persistent. And so the way I think about it is, recession, soft landing. If anybody has a quarter, we can flip a coin afterwards, because I think that that's really what the probabilities are. It effectively feels like 50-50 to me today. But again, I think the bigger issue is that slower growth, even modestly negative growth, will continue to reinforce the disinflationary trend that we've seen over the course of 2023 thus far. And again, that's what the Fed is trying to do. And that's the world that we need to get back to. Right? A world of price stability, where making decisions around investment, financing, so on and so forth is much easier, because you're not sitting there twiddling your thumbs saying, well, is inflation going to be 5 or is it going to be 1? Right? That makes all of our jobs very hard. If is inflation going to be 1.5 or 2.5, then the job becomes a bit more straightforward. So again, we think that we're headed for an environment of slower growth. We think recession or no recession, it's debatable, but it's very unlikely it looks like 2020 or 2008. And so I think that, again, the writing is kind of on the wall in terms of the direction of travel.
So you said something interesting. You said many things interesting.
Thank you. Thank you.
One thing in particular, however, which is you said the banking, that was the first shoe to drop in your mind. What's the next area that you could see being affected negatively? Like where are you guys steering away from there?
So it's not that we're steering away from it, but when we think about what drives U.S. economic growth, it's all about the consumer, right? Consumption is 70% of GDP. And what we see, frankly, is that the consumer is bending, but not necessarily breaking. The savings rate is running well below its long run average. The excess savings that were accumulated during the pandemic, there's more than we thought, not to bore everybody, but the government revised a bunch of data. They found an extra $1 trillion in excess savings. I didn't know you could miss $1 trillion. I certainly wouldn't miss it. And then on top of that, you're seeing signs that, credit cards are being swiped more, and consumer leverage doesn't look anything like it did back in 07 and 08. Again, we're not on the precipice of a financial crisis in our view, but we're watching what happens with corporate profits and the way that companies deal with slower profit growth, because if they end up pulling the employment lever and they begin to lay people off, that's going to reinforce the idea to us that, recession is probably more likely than a simple slowdown in the pace of economic activity. And so watch the labor market, watch the consumer, because a big part of what's supported growth throughout the better part of 2023 has, again, been an unemployment rate that's very low and wage growth that remains, above the long-term average.
Great. Mike, turning to you for a second here. So going into this year, I don't think anyone was expecting markets to, although they pulled back recently a little bit, but to do as well as they've done. What do you make of that? What's the drivers?
Yeah, it's interesting. And I think there's a couple components to it that are important, right? One, it's not across the board, right? As always, there's always this big dispersion in returns amongst equities. And it's at the individual stock level, it's at the asset class level. There has been a wide range of outcomes depending on what you've invested in, right? We were talking about it earlier. The Magnificent Seven companies, right? The biggest companies in the U.S. continue to drive returns, right? It's been a very, very narrow market. You think, and David alluded to it. The AI conversation has been a big tailwind for some businesses, right? NVIDIA being one of the major players, right? NVIDIA has absolutely taken off this year because of their exposure to the necessary chips to run much of AI technology. So it's been a very narrow market. You've seen the NASDAQ 100, you've seen technology, communication services, and even when you decompose that, right, it's NVIDIA, right? It's the Googles, it's the Metas. These are the companies that are driving returns in markets. And these are the companies and the asset classes or sector level that are up high 20s, 30% returns. But for the market as a whole, I think you're right. You've seen low double-digit returns across the board, and it's mostly driven by valuations kind of expanding. We were talking earlier about how we sat here last year and said, what happened in 2022? So much of it was just people not paying as much for the same company that had the same expected earnings for the whole year, right? So if you look at 2022 expected earnings versus where we are today, earnings expectations haven't moved much. What's changed, though, is in 2022, I was willing to pay less for a stock as rates rose. This year, you've seen that reverse a little bit, and people are willing to expand what they're paying for those same stocks. Earnings are still expected to grow pretty reasonably. If you look at the S&P 500, that'd be roughly 220, 225 this year, 250 next year, 270 the year following. Some serious positive growth from an earnings standpoint. What's changed, though, is the valuation component. And then, as David alluded to earlier, this conversation around AI, right? And AI is hopefully going to help the economy as a whole, but there will be winners. There will be losers, right? Right now, a lot of the winners have been in that semiconductor industry, which, as an industry, we really have liked, going back to 2021. But at the end of the day, it's been narrow who's won and who's lost. There are sectors, if you think about all the volatility this year in markets, what usually does well in those type of environments sometimes are more defensive sectors, right? Demand defensive. You look at utilities, you look at staples, they're negative, right? It has been a very narrow market, a lot of crosswinds. By and large, when you ask yourself what's happened and how markets have done well, it's been this AI conversation. It's been this comfort around inflation coming down and the Fed slowing what they're doing from a rate hike perspective. And it's just this valuation multiple increasing. So people willing to spend more on equities with the same earnings that they had, expectation from a year ago.
So you also said something interesting, Mike.
You said a lot of interesting things, Mike.
Thanks, Dave. So
I didn't talk about sweat.
That's right. Is a market that's up because of, as you said, a very narrow sector or holding? Is that troublesome? Is that reason for call?
I wouldn't say it's troublesome. I think what it does is a couple of things. One, I think it psychologically makes people doubt diversification, right? It makes people start to chase things because they see how narrow the market is. If you look at what's priced into Tesla, or not Tesla, a different conversation, but NVIDIA, like their stock, and what needs to happen for NVIDIA's stock to warrant the price that people are paying, they got to hit home runs over and over and over again. Now, they may do that, right? They may continue to drive that space, but I think people have to understand is they've run up, they've done really well. And I think the challenge when you see a narrow market like this is it makes you want to chase, makes you want to gravitate to that narrowness of the market. This goes back to 15 years of U.S. growth equities outperforming. What you typically see, though, is when a market gets narrow like this, if the market has legs, right? If it's truly going to be the start of a continued up market, it will widen out, right? The breadth will get bigger with what equities are driving returns. So I wouldn't necessarily be concerned of the fact that it's a narrow market. All that narrow market does to me, though, is make sure that we educate our clients, our investors on we do not need to be that narrow, one, and that we need to make sure that we are keeping perspective on the other 490 stocks that are in the U.S. market, the other thousands of stocks that are outside the U.S. market for opportunities because they are trading at much more attractive levels than those big seven companies are.
Awesome. David, let's flip the script from stocks to bonds or fixed income. So last year was the worst year ever, I believe, in the bond market, or at least we've been tracking it. This year, I think common theme was stocks may be kind of inverse to where we are. We kind of thought stocks may lag a bit, bonds would recoup. What's going on there? And should people start abandoning fixed income? Is the future bright? Help us understand why we're still here and potentially give us hope for the future.
So I think part of the problem that bonds faced last year was that interest rate volatility was very high, right? For the first time in all three of our lifetimes, we were seeing inflation that was closer to 10 than it was to 0. And that created a lot of questions about, one, the Fed's ability to get that under control. 2, what it means for the interest payments on federal debt going forward. The distribution of outcomes, the questions that we were asking kept on getting larger and larger and larger. That drove tremendous volatility, but that narrative has very much shifted. And now we're seeing inflation come down at a fairly steady pace. We're hearing from the Federal Reserve that maybe there's one more interest rate hike coming before year end, and then they're likely going to be on hold. They may already be on hold, as was suggested in the minutes from the Fed meeting today. And so I don't think you want to abandon fixed income for a couple of reasons. One, there's income in fixed income again. I came out of school in 2009. I entered a world of 0 interest rates. We talked a lot for 10 years about the TINA trade, right? There is no alternative to equities. Bonds aren't paying you anything. Rates are super low. And it felt like rates could only go one way, which was up, which would very much undermine the price of the security. The overall capital markets are now back in a state of balance, back in a state far more similar to what we saw prior to 2008, as opposed to the kind of, wonderland that we've been in of 0 rates over the course of the past 15 years. So there's income in fixed income, which frankly is valuable to a lot of people, particularly as they get closer to and enter into retirement. The second thing is that, we think that rates are nearing the high end of their range. And we did some analysis on this where we looked at the subsequent 1-year performance of cash, high quality fixed income, high yield bonds, and equities following the peak in the federal funds rate during cycles all the way back to the 1980s. High yield kind of depends. Equities generally do pretty well, but you have to stomach some volatility along the way. In every instance, high quality fixed income beat cash. And I know that cash yields are attractive in the current environment. We hear from a lot of folks, why would I buy bonds, which took me to the shed last year when I could just sit in the CD and make 5.5%? And the reality is because duration or interest rate sensitivity works both ways. So in 2022, when rates went up, bond prices went down. But our expectation is that 12 to 18 months from now, bond yields are probably lower than they are today. And so not only do you stand to generate a relatively healthy stream of income in the short term, but in the medium term, you actually may see some capital appreciation. You may see some increase in price. The final point I'll make is a lot of people after 2022 said, why should I own bonds? Because their one job was to diversify my stocks. And they didn't do that. If you go back to you can go all the way back to the 1930s. The relevant period is really the 1970s into the 1980s. Stock bond correlations, or the way that they moved together, it was actually positive, right? So in the 70s and the early 80s, stocks and bonds moved in the same direction. Stocks went up, bonds went up. Stocks went down, bonds went down. That's because inflation was in focus. What we've seen over time is that when inflation is the elephant in the room, stocks and bonds tend to move together. But what are people concerned about today? They're not as concerned about inflation. They think that genie, to an extent, is in the process of being successfully put back into the bottle. They're more worried about the first question around recession, slower growth. And typically when that is what's on investors' minds, bonds do provide the diversification that investors are looking for.
Awesome. Good stuff. So, Mike, Winston Churchill infamously once said it's a enigma wrapped in a riddle, wrapped in a quagmire. And the quagmire this year has been real estate. So interest rates are 7%. Zillow tells me my house is still worth what it was a year or two ago. Is that sustainable?
So no, in some ways, but I think you're hitting on an important point. Intuitively, you want to think of that going from 30-year mortgages at 2.625, right at their low in 2020, to 7.5 today would crush real estate prices, right? And real estate, unfortunately, is driven supply and demand, right? We do expect demand to get pinched quite a bit. Debt is just now more expensive. You know, if you do the math, a $400,000 mortgage at 3% interest versus 7% interest is $1,000 a month difference, right? That hits you differently, right? So we would expect demand to get hit. The catch here is that supply is atrocious. Supply is the problem, and the lack of supply has continued to buoy prices in the real estate market. And we would continue that to be the case. If you look at both the rental space and the inventory of homes, they're at some of the lowest levels, if not the lowest levels we've seen in the last several decades. So no, it's not sustainable. Yes, we would expect demand to get crunched. I mean, I look today, 30-year mortgage is 7.5, right? I refied in 2020 at 2.625, right? It is a completely different world. And the other dynamic is there are thousands and hundreds of thousands of people like me who refinanced at that point in time and are stuck in mortgages that even if they wanted to go buy something else, they don't know what to do because they are sitting on debt that's so cheap that they can't sell their house, or they have to adjust how they approach it, right? And maybe rent it out, right? So I think the supply dynamic is something that's just going to have to play out over time. So while home prices and what we've seen from an increase in those prices is just not sustainable, and we would expect demand to get crunched over time with rates where they're at, it's not just a given that home prices are going to plummet. We certainly don't expect that. It will normalize, but it's going to be driven a lot off of what happens from the supply side of everything.
So, and I've also read that even builders are cutting back. So they're getting ahead of this. So you have sort of a two-pronged attack when it comes to the supply side, which means hopefully softening, not the bottom falling out. So how about corporate real estate?
Commercial real estate, yeah.
Commercial, thank you.
Yeah.
I know that's been it's like you wrote these questions. What do we think about commercial real estate?
Yeah, so I think go back to, February and March, commercial real estate kind of came into the limelight, right? Because regional banks are some of the biggest lenders to commercial real estate buyers, right? They are a vital piece to the commercial real estate world. The key here is that, and I absolutely hate this saying, but you can't throw the baby out with the bathwater. And in some ways, commercial real estate is not just an old office building in the middle of San Francisco, right? It's beyond that. Commercial real estate has a lot of components. So yes, old office buildings in major cities that are vacant are in trouble. However, commercial real estate, if you think about the different tentacles, think about multifamily. We just talked about how the rental market has record low inventory. Multifamily commercial real estate, really healthy. Industrial, really healthy. Think about all the warehouses you drive by on a daily basis, really healthy. Retail is an interesting space, right? Especially grocery anchored. It depends where you are, what anchors the real estate. But by and large, I think commercial real estate was a good opportunity. I still think it's an opportunity for investors, both on kind of the equity side and then on the debt side, depending on how you approach it. But you have to be very careful and very thoughtful and diversified with how you approach it, right? You do not want to buy all office. There are plenty of offices that are doing well and doing fine, but there are certainly parts of that market that are not in a good shape right now. But then there's other parts of commercial real estate that we look at and say that's doing quite healthy, doing quite well, and certainly not warranting everything being lumped into one single commercial real estate bucket, because there's much more to it than just, once again, an old office in the middle of Philly or San Francisco.
Awesome. David, I know you love these questions where you take out your crystal ball and tell us what the Fed is thinking over the next year. So what do you anticipate? You touched on it briefly that maybe they're slowing, if not done, based off information that came out today. But reach into that crystal ball and tell us by the end of next year, what do you see transpiring in the sort of the Fed and interest rate environment?
Sure. So what I would say about that is I see two potential outcomes, neither of which are reflected in what the market is expecting or the Fed is forecasting. So that's just my kind of safety label before I share my thoughts. So I don't think the Fed is done. I think the Fed's going to go one more time before the end of this year. There's been a lot of talk about, well, the move higher in long-term rates is doing the Fed's job for them. Well, over the past couple of days, long rates have come back down, given what's going on in other parts of the world. And so I think that the Fed is going to put one final nail in the inflation coffin before they call it a day. Then, assuming no recession, I think they stay on hold through the end of 2024.
Wow.
I think if the economy continues to grow at a relatively decent pace, there's no reason for the Fed to cut rates just for the sake of cutting them, right? If interest rates are meant to slow activity and we get to a level where activity has slowed enough and inflation continues to come back down, then, why adjust relative to that baseline? On the other hand, if we have a recession, the Fed will respond, right? And I think that they will cut rates aggressively. I don't think that they will go to zero, but I do think that they would ease policy in the face of an economic contraction. So that's my view. On the other hand, the market thinks that we're going to have a soft landing or no recession, and the Fed is going to cut by 1 percentage point over the course of the coming year. And then the Fed's own forecasts also show no recession, and they see 2 25 basis point cuts over the course of 2024. I can't get to 2 or 4 cuts. I can get to 8 to 10 cuts or no cuts. And that's the way I'm thinking about the Fed. And at the end of the day, the skeletons of the 1970s are still rattling around quite loudly in Jerome Powell's closet. And, for those of you who don't remember, Arthur Burns, who was the Fed chair in the 1970s, I did read this in a book, clearly. Arthur Burns, who was a Fed chair in the 1970s, basically tightened policy in an effort to kill inflation, then began to ease policy prematurely, and that forced him to re-engage. And finally, we all know what Volcker came in and did to crash the economy and bring inflation back down to more reasonable levels. Powell doesn't want to go down in history as making that same mistake. And so to me, this is a Fed that's likely going to measure twice and cut once and err on the side of caution. Because frankly, if the economy rolls over, they know how to stimulate growth, right? You cut interest rates. If inflation gets out of hand, you're just creating more pain down the road as you try to get it back into some sort of check. And so I think I'm definitely on the more hawkish side, particularly within the walls of JP Morgan. But I think inflation is still public enemy number one, and the Fed is going to maintain tight policy for as long as they can until something breaks in the labor market that they are no longer able to ignore.
Mike, your crystal ball?
What he said.
All right. Perfect. All right. Next, we're gonna enter our rapid fire question mode here. So I'm gonna go back and forth on 4 questions. Really, 2 questions divided by 2. Multiplied by 2. I'm good at math. And David, give us something to be excited about in the markets over the next year.
Oh, in the markets, I was going to say the Phillies. The Philly country.
Or Eagles, right?
Better than my Red Sox. So one thing that I think we can be excited about in markets over the coming year is back to your question about fixed income, right? Because there's income available. You're actually getting paid a positive inflation-adjusted return, and you have the potential for capital appreciation if and when interest rates begin to decline. So, if it was Thanksgiving, I would tell my family that I was thankful yields have gone up and I'm thankful for fixed income.
All right, Mike. Well, he took a good one, so I'll stick more on the equity side right here. So what excites me what I'm optimistic about is the fact that these businesses and these companies, when they've had time to prepare for higher rates, the most anticipated recession, they can do a really good job preparing themselves. You've seen margins remain pretty strong. You've seen labor markets remain really strong. I think corporate health is really strong right now, and it has a lot of room, and there's a lot of downside that you can be absorbed before anything really concerning comes into play. So on the equity side, I think corporate health is something to be really excited about, and it affects both equity markets and debt markets moving forward.
All right. On the opposite side, give us your big concern over the next 12 months.
So generally speaking, I'd agree with everything you said about corporates. I think the economy looks pretty decent. I'm worried about the fuzzy stuff. I'm worried about the mushy stuff. I'm worried about the politics. I'm worried about the geopolitics. I'm worried about the social fabric. That was my concern coming into the year. I know we still have, 2.5 months to go, but I'm feeling, unfortunately, like I was right. I think that we need to watch politics and policy going forward because we are in a world that is clearly unstable and increasingly divided.
Said beautifully. Mike?
Yeah, I'll stick to the not depressing stuff in some ways. Well, maybe it is depressing. I'm worried about the consumer, right? I think that, you alluded to earlier, the consumer is 70% of US GDP. We are a consumer-driven economy, and we're seeing a couple of things that are starting to get a little bit concerning. One, credit usage is increasing. We don't love seeing that. Two, excess savings, right? All those savings that were passed out by the government, they've been spent and they're being spent. I think JP Morgan had done that great measure. I think there were $200 billion left. And they're projected to run out by year end. That's naturally a concern there. Savings rates are very low. If we do start to see more of a recessionary environment or labor markets start to weaken, savings rates will increase. That's what people do, and that's just less money that's spending around. So from a concerning perspective, I get concerned that the consumer is starting to crack. Right? They're bending, but not breaking.
All right. So last question, Mike. I'd be remiss before we open up for anyone in the audience to ask a couple questions. But you manage literally everyone in this, including myself, in this room's portfolios. So give us a look behind the Diversified and your team's positioning, what you're looking at, moves for the perceived next 6 months or so. Like, what do you like?
And let me be clear. Andrew would be and is the worst client possible.
You don't know my mom. Who's watching? Well, I love you, Mom.
I think the term, and David, I'd love to hear your thoughts too, anything different, but I think the term across the board is quality, right? Now is not a time, I think both within equity or fixed income, where you need to take excessive risk. Within equities, we're going to be biased towards US. We're going to be biased towards large cap. Small companies look pretty attractive from a price perspective, right? They're pretty cheap relative to US large cap. The challenge is where we are today in the cycle and with the risks out there. It's just not a time where we want to start ratcheting up the risk in our portfolio. So we're just higher quality on the equity side. We have more of an allocation to dividend focused equities. We do have our lean towards semiconductors and things like that. But at the end of the day, heavier emphasis on mature US businesses, higher quality, light on small cap, light on emerging markets where we just don't feel like the risk is needed right now. And on the fixed income side, it's the same conversation. You don't have to stretch for yield. You no longer have to go down into below investment grade fixed income to start to get any income. You can get that in treasuries, in investment grade corporates, mortgage-backed securities, commercial mortgage-backed securities. There's a lot of opportunity in the investment grade world. So if you look at our portfolios, they're going to be much heavier in those spaces. We're going to be light and high yield, which looks relatively expensive, right? Because the market is just pricing in a very low default rate. It doesn't expect a whole lot of turbulence right now. You don't need to reach down there. You can stay in high quality, get high quality yield, diversification from equities. And I think when the opportunities present themselves to add risk to portfolios, whether it be via small cap, whether it be via emerging markets or high yield or some below investment grade fixed income, you take those opportunities. But until you're compensated or it makes sense to do so, we're not going to be overly allocated to those areas.
Yeah, I mean, I think that I would very much agree with that. The way that I put it to a client this morning is that this is not a market for heroes, right? Do not try to swing for the fences. Just try to hit a single or double or get on base. I don't think you want to take excessive risk.
Go Phils.
Actually,
okay, so let's make this interactive. First, I have a question for all of you. Who's the best dressed up here? If you think me, raise your hand. Raise your hands. And it's settled. So, questions. So let's let you guys ask some questions. Probably not to me since they're here. They make me look bad. Except in dress. So any questions that you want to pose that's on your mind? I see him itching, Mr. Wilkie. Go ahead. You got a question?
Sarah. Thank you.
And I'll repeat it as well. Okay. The question was. Okay. So for all this, I couldn't hear. Oh, just You're out of questions.
Oh, geez.
So, the first question was where and when, back to the crystal ball game, when and where do you see the next quote unquote bubble to burst? And the next second question too was how much do you admire me? What's the question? Oh, sorry. Let's stick to the first one for time being.
So, I mean, I think that if we were having this conversation in 2021, I would tell you that there was a bubble in things like crypto and meme stocks, and all of those have basically been popped. I think that there's a bubble forming in the private markets. And I think that the private markets benefited from, again, 15 years of zero rates where you could basically fund any company. And since the cost of capital was non-existent, that company could survive. And I'm not saying, again, I'll steal your term. I'm not saying we should throw the baby out with the bathwater and private market investments are problematic in aggregate. But when we look at certain areas of the private markets, and particularly things like private lending, we do get a little bit concerned that, perhaps in a world of very low yields, too much money was pumped into an asset class that provided healthy yield. And that gives me a little bit of pause on that side of the equation going forward. In terms of who I admire the most, other than you.
Current company excluded.
Yeah, current company excluded. I would probably say Thomas Jefferson. That would be my answer.
Ooh.
Smart guy.
Good one.
Yeah, thanks.
Allegedly. And confirm it, Mike.
I'm not going to have a good one for that. I'm like stressing up here.
Yeah.
It really is. From a bubble perspective, I think that's a good one. And I think part of the challenge is right now you don't see those, right? You really don't see them, but they kind of come out of nowhere sometimes, and sometimes they slap you right in the face. I think there is a natural concern in the unprofitable world. I think I forget which newsletter I did. Maybe it was 2 quarters ago, which shameless plug. I put out a newsletter. It's great reading. So meme stocks grew so quickly and unprofitable tech grew so quickly. And I think that became a natural concern, right? There was so much money being pumped into areas that were just so lofty and had so much length before there was any profitability at that point. I think that's naturally the biggest concern, right? There's still a big contingent of the Russell 2000, which is the U.S. small cap index, that is unprofitable, right? Still no positive cash flow at the end of the day. And to us, I think private markets is naturally a good one because of, the private equity world and all these worlds that have been able to get away with such low rates. But same thing with the such low rates with just unprofitable tech, which is just now less of a concern. I think it's less of a bubble, but it's certainly still a concern that so much of the Russell 2000 and so many parts of the market is unprofitable, which is why we want to stay as high quality as possible, because I just don't see the benefit. As rates rise, it is a very different environment than we were when rates were zero, right? When lending costs were virtually nothing. I have no idea.
Okay.
I'm going to go with Aaron Nola because I'm hoping he's throwing really well.
Yeah, do we have confirm if they
That's good to hear.
see a question back here? Mr. Burke. Oh, turning the wrong way. Question is digital currency. You asked this the other week. He's not satisfied. Probably because I said wait till today. So digital currency. Brett, does this concern us? Is it if it's consumer? Is it individual?
So I would differentiate between something like Bitcoin and something like a CBDC, right? A central bank digital currency, which is effectively just a digital dollar. I don't worry about a digital dollar. I don't worry about FedNow. It's a more effective, efficient way of processing payments, period, hard stop. Blockchain technology is incredibly powerful, and in the right hands, and I would argue that policymakers like the Fed are usually the right hands. I actually think that it'll be very beneficial for the economy over time. Now, in terms of the Fed having insight to our personal finances, I'm pretty confident if the Fed wanted to look at my bank account today, they'd be able to do so. And so I view that as less of a concern. Maybe it's because I'm a good, upstanding, well-behaved individual. But I do think that, the concern about digital currencies really stems from the nefarious behavior that we've seen with things like Bitcoin. But that's because it's a distributed ledger that is effectively anonymous, right? A CBDC with oversight from the Fed, you're not going to be able to get away with the things that you've been able to get away with more traditional crypto, because they will be monitoring and have oversight over that full platform. So to me, are there some risks? Absolutely. Anytime you introduce technology, there's always new risk that comes with it. But I think that in general, those risks probably, or the rewards rather, probably outweigh any potential risks.
How about the Bitcoins of the world? Where does that land?
So
5 years from now.
So, I mean, it'll ask me in 5 years, because, a Bitcoin is only worth what somebody will give you for it, right? A US dollar is backed by the full faith and credit of the US government. And those are two completely different things. There are no cash flows of Bitcoin that we can sit up here and discount and figure out what intrinsic value may be. It's literally worth what somebody will pay you for it. And so when people are worried about inflation, or, they want to do things kind of beneath the surface, right? Currencies like Bitcoin tend to gain in value. But as we've seen, entire currencies can be erased overnight. And that's coming from somebody who had a front seat to all of this, because my wife used to work at BlockFi. So I was very involved, not personally, but very informed, I should say, as the whole, FTX thing went down at the end of last year. So we are not crypto enthusiasts, but we do see value in digital currencies issued by central banks.
Let's take one or two more, being mindful of time. If there are one or two more. Oh, go ahead.
To roll off of the last days, I wanted to know you guys' opinion on centralized banking, if you didn't already give your full opinion on it, with the currency. But also, I do have a second question. I apologize. I did also want to ask you guys' opinion based off of what you are stating, David, the world, everything that's going on, the world economy, I hate to say it, but wars that are going on, things like that. I kind of wanted to do you guys' perspective from that.
Okay. So two-part question. One, riding the coattails of last one, David, maybe take that as far as centralized banking, right? Sort of the continuation of that. And then the whole world's at war, seemingly. Does this affect the markets in the short term?
Yeah. So to me, centralized banking is a good thing. I think a fractional reserve system is far more, far better for the creation and flow of credit, which is what really drives economic growth over time. The issue is if we had a decentralized banking system, let's say that we all relied on Bitcoin and the distributed ledger, so on and so forth, you wouldn't be able to basically create money out of thin air, right? Which is what with a fractional reserve system, banks are basically able to do. If you come to me and you want a loan, I don't necessarily have the money, right? I can take some deposits, I can lend you the deposits, and I know if I need to, I can go knock on the Fed's door and make the depositor whole if they come to withdraw their funds. So to me, I think that the current system, frankly, works pretty well. On the political and the geopolitical front, and I'd love to get your take on this as well. So it's very easy to get wrapped up in how you feel about something, but these are instances where we try to differentiate how we feel and how we think. And so to me, anytime that there's political or geopolitical tension in the world, I think about the channels through which it can affect the economy and the markets. And there are basically two channels: commodity prices and government spending. And so to me, what I'm watching closely are, things like what happens to the price of oil, given that we're experiencing a pretty significant conflict in the Middle East. Israel actually doesn't produce any oil, but if it broadens out, it could evolve into a bigger problem. And then you think about the potential response to these things. We've seen it in Ukraine in the form of NATO sending support. We are seeing it in real time with the events in the Middle East, right? Defense spending is set to ramp up. And again, back to what I was saying earlier, you're seeing this fiscal expansion. You're seeing this increase in government spending occur at a time where, frankly, the economy doesn't need that type of tailwind. And that makes me a little bit nervous that the well might be a bit drier than would otherwise be the case when the economy really needs a bit of water.
Right.
Yeah,
fine.
I agree with everything he said. I think thinking about it in two different channels for kind of any time geopolitical risk happens, right? Whether it be Russia invading Ukraine, that was unfortunately going on right now, the potential for China invading Taiwan, right? That literally overhangs us kind of on a daily basis of what could happen in that scenario. In the end, it's a couple different things. One, I think it's important to know that the market will tell you what you probably should think of it. And at least from a financial markets perspective, right? And that's kind of where you kind of get, insensitive to what's actually happening. But putting your emotions aside, the market kind of tells you what you should think of its market impact at the spending or the consumer level or the earnings level, whatever it happens to be. So I think the market has largely discounted that it won't have a huge effect from a market perspective, at least from a stock and bond perspective. Now, on the other hand, on the commodity side is something to consider because, frankly, anytime something happens in the Middle East, that's always a natural concern. If Iran gets involved, I think the biggest impact would be at the commodity level. Oil prices continue to rise. And that could obviously stem through and hurt other areas of the economy. But by and large, at least, from a financial market standpoint, it shouldn't be a huge impact. And that's what the market's telling you right now.
All right. We are bottom of the ninth, 2 outs, Phillies for the World Series. Last question. We got one more. Right here, the lovely Margie. Oh. Okay. So the question, we brought in even a little bit, climate change and alternative energy, right? Is this something you're considering? Is it, again, from the market's perspective, right? Separating, as you pointed out before, from the personal side of it or the emotional side. How does this come into play from an investment standpoint, Mark?
Yeah. I think at the most basic high level, it impacts it because we're always looking at where the flow of capital is going to go, where investment's going, what are the opportunities? Because in the end, we want our portfolios to drive returns over time, right? And where financial capital goes, where the opportunities are. From that perspective, we pay attention to it. Does it impact our portfolios today? I would say probably not much. In the end, right? Oil producers are still driving massive cash flows. The investment is still in early progress across so many different technologies. But, a company like Tesla, naturally, with what they're trying to do, has been rewarded for their kind of frontline efforts, at least on the automobile side. And in China, the BYDs of the world have been rewarded. So I think it impacts our portfolios mostly from how we think about where the flow of capital is going to be going, where the opportunity sets are, where the profitability could happen, where government spending, right? Where's the government going to put this capital and where's it going to give incentives, right? People do what they're incentivized to do. So all of those things impact how we think about it. But I wouldn't say we are certainly attacking it from just an overarching perspective.
David, why don't you take a different perspective on this and tell us, if you're looking at this space, where you would be most bullish in this sort of climate changey, alternative energy type of stuff.
Sure. So the first thing I'll say, just to reinforce your point, is that one of the things that's happened over the past couple of years is consumer preferences and policy initiatives have finally become more aligned, right? Prior to COVID, we all knew that climate change was a problem and that we should probably do something about it, but there was no effort on the side of the government to support that change. We're now swimming in the same direction, and that is a very powerful thing because the private sector or the government sector are unable to achieve what needs to be achieved by themselves, right? It's going to take a combination of both public and private funding. In terms of where we see the most interesting opportunities today, on the one hand, a more conservative way to play this is to own the big integrated energy firms, right? An ExxonMobil, Royal Dutch Shell, because they have one foot on either side of the line. So for people like me who recognize it's probably going to take longer than a lot of people think to make this transition to a greener world, and in the interim, we don't necessarily want to completely abandon exposure to fossil fuels because that's what most of the world continues to use. To me, that's a really interesting way of playing both sides of the coin. double clicking on kind of the energy transition and renewables, we think that natural gas is particularly interesting and arguably the low hanging fruit when we look at the current environment. Beyond that, things like wind and solar are beginning to gain more traction. Rather than betting on those themselves, we're more interested in betting on the things that support that transition. So we have a fund that we run at JP Morgan, which is basically a global transportation strategy. Like we own like container ships and airplanes and so on and so forth. We own a fleet of ships. Their sole purpose is to go out into the ocean to wind farms, attach themselves to the turbines, and then provide lodging for the people that need to service those wind turbines, right? So we're interested in the infrastructure of all of this rather than betting on some new technology way down the road. And we think that that's a better way of generating those returns that you were alluding to during your prepared remarks.
Great. Ladies and gentlemen, thank you for coming. Let's give these two a wild round of applause. Thank you. Thank you for coming out tonight. Again, from the bottom of my heart, from all the partners and my colleagues here at Diversified. We love you guys. We are thankful for you. We don't take anything for granted. You have a choice when it comes to who to trust with your dreams and wishes, and hopefully you continue to have faith in us. So thank you very much, and a round of applause for you.